All right, welcome back to another edition of Financial Accounting. We left off right about here. We were talking about calculating the market price of the bonds. So bonds are weird in the sense that we have to calculate the present value of the lump sum that we pay off our investors at the maturity date, as well as the present value of the streams, the interest payments, which are consistent and based off of the stated rate. So stated rate determines the cash payments. Market rate is determining the present value of all of those cash flows. So really the stated rate only helps us determine the actual cash streams that we have to pay out. It's the market rate that's determining all of this. So when we are calculating the present value, we're using the market rate and the present value tables to determine not just the present value of the lump sum, but also the present value of the annuity payments. In the case where the market rate equals the stated rate, investors are getting exactly what they want. They're going to give us an investment exactly what we want. That was the 100,000. In the situation where we are offering 10%, but let's just say right before we issue it, the market rate drops to 8%. What does this mean? It means that the market is comfortable getting an amount less than what we are legally required to pay them. We're legally required to pay them 10% annually. They're like, dude, I'm fine with 8%. It's 10%, fine. You pay me more. Let's go. 10% is what we're legally required to do. We're not going to reprint these bonds with 8%. It's too costly to do that. So if we issue these bonds and we promise to pay 10%, even though they're fine with 8%, what can we do on our side and in the market to make sure everything is fair? Because ultimately, we don't want to be paying more than what the market actually wants. We want to pay essentially what the market is demanding, 8%. So how do we do this? Well, we find is when we take the present value of the lump sum and the stated rate payments of interest, but we use factors based off of the market rate. In this case, it would be the 8% divided by 2. So the 4% is what we're using. 10 is our 10 payments, 4% is the interest. If we're using these factors, what we find is we're going to actually collect $108,000 from our investors up front. We'll explain a little bit more about why we're getting more cash up front from these investors in a little bit. But the present value, in the case where we're offering our stated rate higher than the market actually wants, we're going to collect more cash. That's a situation where we have a premium. We're issuing these things at a premium. What if right before we issue the bonds, the rate actually goes up higher than their stated rate? Stocks are doing really well, for instance. Okay, nobody really wants to do bonds because the market's doing more. So anybody who wants to invest in bonds, they're going to demand a pretty high rate of return. We're out there saying, hey, we'll offer you 10% bonds. And what, dude, really? We'll say, no. Here, we'll make a really good deal for you. If we issue bonds at a discount, what does that look like? Situation where the market wants more than what we're giving them. We have to discount our prices because, hey, to make things more attractive, we want to reduce the price. So in this case, we're going to use present value factors that are based off of a 12% divided by 2. So that it's actually going to be 6%. The factor on the present value table says the 6% because that's the market. The number of periods is 10. So when we use those factors, we take the present value of those future cash flows, we figure out that the market price of the bond, the cash that we actually receive is going to be 92,640, which is a discount from the 100,000, meaning that, hey, look, investors, we really want to issue these bonds. Tell you what, give us 92,000. You don't have to give us the full 100,000, just give us 92,000. Okay? We'll explain the difference and how that's important later on here. So, in summary, we've got 3 situations. We issue the bonds at par or face. We get exactly what the face value is. That's considered a price, a quoted price of a 100. And so what we do is to determine the quoted price, we're basically taking the proceeds and we're dividing it by the face value. So in this case, it's the 100,000 divided by the 100,000. But what about if we sell it at a premium? Well, the quoted price, what we would see on the market is 108. On the exam, sometimes I give you this information. Sometimes I tell you what the proceeds are. Sometimes I just tell you what the price is. What is the price? It's a percentage of face. So if I get 108,000 111 divided by the face value of 100, right? That gets me a 100, roughly about 108%. And that's what the quoted price is. It's stated as a percentage of face value. If I issue it at a discount, what do I have? 92,640 divided by 100,000. The price, therefore, is going to be 92.6% of face. That's how quoted prices work. In fact, if you go on to, if you just do a Google Finance or go to finance.google.com and you look up US Treasury bonds or you look up any corporate bonds, what you'll see is right now a lot of them are trading below face value. And that's because the stock market's doing really, really well. When the stock market doesn't do well, all of a sudden people are like, yeah, I like those bonds. Yeah, and they start seeing that bonds start selling at a premium. In the crash in 2008, when we had the financial crisis, it was ridiculous. Bond prices were well above 100, the quoted price of 100. Most every bond was trading in the 105, 106, even higher range because people were desperate for the protection. So they moved out of stocks and into bonds. That made bonds really attractive. When bonds are really excited and people are really excited about bonds and they're very attractive, they sell at a premium. When people want stocks, bonds kind of like go the wayside. Anyways, those are the three scenarios we're going to look at here. Now, in the case where, let's see here, we're talking about these different prices, these proceeds that we receive, it's based off of market sentiment. And it's really, when we're looking at the calculations, the present value calculations, we only have to look at the market sentiment once, and that is at the issuance statement, because it's that price that determines the accounting that we have to do in day 2 and onwards. So it's not like we have to keep doing these pricing evaluations over and over and over again. We only have to do these pricing evaluations once when we issue these bonds. After we issue the bonds will probably trade on the bond market. Bond markets are like stock markets. They're essentially what are considered secondary markets. Primary markets are when we actually issue things for the first time. We issue stock for the first time in an IPO or an SEO. That is the market we use as the primary market. Okay, the secondary markets like the NYSE and the bond market. We don't really care about how the values change on those markets. It's only the values we care about when we issue them that determines the accounting we have to do. So when we determine on the issuance date what the price is, what are the journal entries in these various scenarios? We issue bonds at 10%. The market likes a 10%. So the price we issue them for is 100% of face. It's pretty much debit cash, credit bonds payable. Pretty straightforward, just kind of like a note payable. And then you see down below, I think there was a little typo there. Down below, we just basically plug in a credit to the bonds payable, 100,000. We got the cash, 100,000. Nothing too mysterious when we issue bonds at face. And generally speaking, we try to issue them really close at face at the market rate, in which case we'll issue them at par. But what if we issue the bonds at a premium? This is where it gets a little tricky for the accounting. Now, my recommendation is be able to sketch this out on the exam on scratch paper. Okay, if I tell you the bonds are selling at 108, or if I tell you what the proceeds are, 111,000, just be ready to just take the face value, multiply it by 108, or just plug in a debit to cash for 108. Okay, that's step 1. Step 2 is plug in for the bonds payable, the credit, plug in the face value, because that's the amount that we have to pay them at maturity. Then look at the journal entry and figure out, do I need another debit or do I need another credit? In this case, I need another credit. This becomes your plugged figure. I need another credit of 8,111. What does that represent? In this case, it's the premium on bonds payable. This acts as a valuation account. It's not quite a contra account because contra accounts act contrary to what the typical account does. So in this case, we've got these two accounts are basically paired up together. Okay, we're basically, what we're doing here is we're saying it's not just the face value of the bonds that we want to report on the balance sheet. We want to report any adjustments to those up or down depending on what we sold them for. If we sold them at a premium, then the ultimate value we're going to report is what's called carrying value of 108,111. That would be the carrying value. We'll talk a little bit more about that in a second. But this premium account is important because We eventually need to amortize this balance away. And we'll talk about that and show you the mechanics of how to do that in a second. In the case where we sell the bonds at a discount, we didn't get as much as we wanted, that's fine. Step one, plug in the cash that you did receive as the debit. Step two, plug in the face amount of the bonds as the credit. That's always going to be face. It's always going to be face. Then figure out, what do I need? Another debit or another credit. In this case, to make this journal entry balance, I need another debit. What do we call that? In this case, because I didn't get the full amount I wanted, we call that a discount. We had to discount our bonds payable to an amount that was more appealing to the investors. So in the T account, there it is. There's the credit. You can see here, we would net those two to determine the carrying value. The carrying value at this point in time is just the 92,640. Carrying value is what we report. We keep track of the different amounts in separate accounts. Primarily, we leave the bonds payable T account alone. We don't really change this account. It's only the discount or premium accounts that we have to adjust over time. So this leads me into, this is where I was going to get into next, is this amortization schedule. So let me move into today's topic. Bond rates determine the bond prices. We know that. But realize that the reason why we have a difference between the proceeds we wanted, the face value, and the proceeds we actually got is because the market value differed relative to the stated rate. Market rates are going to be whatever they are, but it's what the reason that's driving getting more or less than face is the market rate relative to the stated rate. So they're both rates are important, but primarily we only care about knowing both those rates at the issuance date, okay, because those are where the calculations take place. So in the situation where we have the stated rate equal to the market rate, that was example 4A, what you'll see is accounting for the bonds is very similar to how we accounted for the notes payable. So down below, I kind of give you everything in one page. If we issue this sucker at par, there's not a lot of magic behind the journal entries. We got the cash of 100, we credit the bonds payable. Every time we make a semi-annual payment of interest, the cash we pay, which is based on the stated rate, this says right there, stated rate, that amount is always going to be 5,000. The interest expense we report is always going to be based on market. In this case, you don't have to really worry about the two because they're both the same. So we're basically going to be paying exactly what the market wanted, debit the interest expense, credit cash, or credit the interest payable, depending on if we have to make an accrual. What do we do at the maturity date? Well, at the maturity date, we're just paying off the face value of the bonds. The bonds payable account is rarely touched. So here we're simply saying is bonds are due. We got to pay back the face value to the investors, pay $100,000 in cash. Okay. And granted, if there's any interest payable that we have to pay off, we'd have to do that as well. Credit cash, debit the interest payable account. But the bottom line is this is always going to be based on the face value. We're always going to be doing this. Regardless of how much we got, we're always going to be paying off the face value. So this is very similar to what we've done in the past when we're accounting for a note payable. Not too much magic there. The tricky part that people get stuck on in terms of the exam is when the stated rate is not the same as the market rate. And again, the scenario quite literally is the market sentiment towards our bonds is either really good or really bad. So when we don't have agreement between the market and our bonds, potentially we have situations where we've got premiums or discounts, and those need to be amortized away. And I'll show you how we do that in a couple different methods here. Just realize the key thing here is the cash payment we make, which is based off the stated rate, is going to be always different than the actual interest expense we recognize. Interest expense is always going to be based on the market rate. The true cost of borrowing is the market rate. True cost to us is the market rate. Therefore, interest expense is going to be based on the market rate. Bonds are sold at a premium. People freaking love our bonds because there's no other investment out there that pays them more than 8% except ours. So when we have something that people really like, let's not just sell it at normal retail price. Let's jack up the price, right? So we're getting more cash. That's why we got the 108 instead of just the 100,000. We have this bond payable premium account. The carrying value when we have a premium is the bonds payable 100,000 face plus whatever the premium balance is in this case. It's just the 108. 108, 111 is the carrying value. The problem with this is that we need to have this carrying value equal to 100,000 when we pay off the bond. So it's not that we can just leave this carrying value as is for 5 years, because the carrying value essentially represents debt. But by the time we pay off the bond, the debt is actually only 100,000. It's just the face value. The interest itself, we deal with that, as we pay it off. But the carrying value, what the bond is actually shown as debt, it needs to represent the current value on our balance sheet. So down below, what I'm simply saying is by the time this thing matures in 5 years, the carrying value needs to just equal the bond's payable face value, and any premium or discount needs to go to zero. It needs to be zero by the time we pay this thing off. So how do we make that happen? Well, the premium account has a credit balance. So periodically, we need to debit the premium account little by little, chip it away till it gets to zero. The journal entry then is to take this credit balance, and every time we make an interest payment, we're going to debit the premium account. And we're going to chip away, chip away, chip away, chip away until it gets down to zero. So yes, it does start at 108, but it's going to decrease over time to the $100,000 carrying value, which is the face. That's how much we pay off at the maturity date. A little bit tricky. How do we reduce little by little this premium balance? Well, there's a couple methods. The easiest method to use is the straight line method, and that's what we talk about first in the book. Basically saying, look, take this 8,011 and divide it by the number of payment periods, which is 10. If we do that, then we can just straight line amortize away this premium at $811 each interest payment period. So the journal entry, whenever we make an interest payment, is like this, and it's always like this. We're going to be making a $5,000 payment in cash. That's based on the stated percentage. The amount of the premium we amortize is 811. That's step 2. So 1, 2. Take a look at this journal entry. You see that we need another 4189 debit. That's what your true interest expense is. Our true interest expense is about $4,200. It's not $5,000. We're paying cash for $5,000 every single time we make an interest payment. But the true cost to us is only $4,200. Think about it like this, right? The market wanted 8% per year, or roughly about, when you divide that by 2, roughly it's about 4% every 6 months, right? This represents 5% every 6 months. Why are we paying them more? Well, we're not. We're actually not paying them more. This 811 extra that's going into the payment, it's actually coming from them. And the reason why is because if we look at our bank, if we pull out $4,200 from our own bank account, and this big pile over here, this is kind of like, represents a cash pile, that's the 8,111 extra that they gave me at the issuance date. That $8,000 they gave me extra on the issuance date, I'm going to pull from that $800. So it's not like I'm really keeping the extra 8,000. I mean, it's nice that they gave me an extra 8,000, but why? Why did they give me 8,000 above face? Because I'm going to use their money to help make the interest payments to them. The total amount of interest cash that I'm paying is 5,000. And they're not stupid. They're not like, oh, what an idiot, 5,000 bucks. No, they know. They're sophisticated enough to know, like, part of this $5,000 that they're getting every 6 months, part of that is actually a return of their initial investment, 800 bucks. So they know this stuff. Bottom line is the true cost is roughly more like the market rate. It's not really based on the state. The stated rate just tells us how much cash legally we have to pay out. The true cost of borrowing is only about what the market's saying. So if we do this straight line amortization, what we're going to do is we're starting off at a really high carrying value. This is very high. The carrying value is very high, right? But it's going to shrink down to the face value, to just face by the time it's all said and done. Just chip away, chip away, chip away, chip away. 811 every time I make a payment. The journal entry is the exact same because we're using the straight line method. So in the case where we make any type of interest payment on a bond that is issued at a premium, the interest expense is always going to be less than the actual cash we pay out. Cash will always be 5,000 regardless if it's premium or discount. But in this case, if we sell at a premium, the interest expense is always going to be less than the cash we pay out. That's because we're using some of their cash to make those $5,000 interest payments. But what do we pay at maturity date? Guess what? It's just the face value. Right? They gave us 108,000. That's for sure. They gave us 108,111. What happened to all that money? We gave it all back. They gave us 108. 100,000 of it we gave them at maturity. That's what we see up above here. What about the extra 8,000? Well, the extra 8,000 we paid them back that balance little by little every time we make an interest payment. So did they get their full $108,000 back? Yes, they did. It's just the timing of when that happened. Bottom line is the stated rate legally determines how much we have to pay every single payment period. There's no way around that. But our true cost of borrowing is what we actually pulled out of our own cash account to make those payments, which is roughly about $4,000, $4,200. The market rate is what's determining the true cost. And that's representing on the investor side, their true interest revenue is based on the 4%, based on the market. So bottom line is the market wanted 8%. They got 8%. How much did it cost us? 8%. What did they get? 8%, right? The cash flows didn't quite match up with that simply because we were sort of binded legally to this 10% stated rate. The 10% stated rate, that's fixed. We can't move that around. So we started with 811. We paid that back little by little to help make these $5,000 cash interest payments. True cost to us was more like $4,000 out of our bank account. That's how bonds work. When you issue bonds at a premium, people are giving more cash up front. We're using that extra cash to make those legally required interest payments. In the case where bonds are sold at a discount, it's the opposite effect. Okay? We're giving a cash payment that's going to be less than what they really want. So we start off with this discount on bonds payable. So the carrying value we know is going to be below face, 92,640. This balance needs to be brought back up to 100,000 by the time the bond matures. So we're starting low and we're going to go up high. Granted, some people look at this and say, wait a minute, why, what do we, that 7,360, we're going to pay them back a full 100,000 at the maturity date. They only paid us 92, so why are we giving them the full 100,000 at the end? And the reason why is because every time we make an interest payment at 5%, it really doesn't represent the 6% market rate that they're getting. So it looks like we're shortchanging them or we're ripping them off. Bonds issued at a discount, we need the carrying value to equal just the face value. In other words, we need the discount account to be zero by the time this thing matures. How do we do that? We have to amortize it away little by little. So the journal entry, to get rid of this debit balance, the journal entry every interest payment date is going to include a credit to the discount on bonds payable. That chips away the account balance to make it go to zero. So we're starting low, right? And we're going to get up to a bigger amount over time. 92,600. Slowly, the current carrying value will go up to 100,000 if we amortize away things correctly. How do we do that? Same thing as we saw before with the premium. We're going to do it on a straight line basis. So down below, straight line method. Take the 7,360 divided by 10 periods. What do you get? 736 is the amount of amortization of the discount. Or is this premium discount? This should be discount. Good God, Brett. This should say discount. That's my bad. Discount on bonds payable. We plug in the 736. We plug in the amount that we have to legally pay. What's the difference? It's going to be the interest expense, 5736. Why is the interest expense higher than the actual cash amount that we pay out? Because the cash amount we pay out is legally required. We have to pay 5% every 6 months. The market actually wants something closer to about 6%. So it looks like we're ripping them off, right? Not exactly, okay? The amount that we're not paying them every interest pay period, that ultimately will be paid back to them. It just happens in a lump chunk at the end of the period when we pay off the entire balance of the loan or the bond payable. So there it goes. 736, 736, 736, chips away. We get it down to zero. Boom. Carrying value at maturity is going to equal face value. Right? Starts off low, ends up high. Interest expense is always going to be higher than the cash amount we pay when there's a discount, because in fact they actually wanted a higher rate of return. Mechanics are a little bit challenging, but if we do it right, we'll know that by the time we get to the maturity date, the entire carrying value is just going to be worth $100,000. There's going to be no discount left over. We just have the bond face value to pay off, so we do that. We pay that sucker off. Again, this looks a little bit weird. They paid us initially $92,640 at the start. We paid them back how much? $100,000. So we gave them $7,360 more at the maturity date. Why did we do that? Because they wanted roughly 6% every pay period. They only got 5% in cash. So this extra amount that we're paying at the end, that's like, hey, that's the delayed amount. That's the 2% difference they did not get whenever we paid them, or the 2% difference or the 1% difference every pay period, 2% annually. So we're paying legally stated rate, the market rates determine the true cost. So what did investors ultimately get? They got an extra 7,360, which compensated them for the additional amount that they really wanted. They wanted 12%. We gave them effectively 12% interest. We just did it not when we made the interest payments. We gave them 5% every time we made the interest payments. The extra 1%, we just sort of kept track of that and paid them all that difference at the end when we paid off the loan. So the face value, when you think about the face value payoff, we know that it was $100,000, right? But to the investor, they're looking at this and saying, well, 92,640, that's how much I invested. And this other 7,360, this extra they're adding on top of that, that's just compensation for not paying me my full 6% every time there's an interest payment. So there's no free lunch at all when it comes to bonds. We give the market, we give investors exactly what the market rate is that they're demanding. Okay, the cash flows just don't quite match up with what the market is actually demanding. The straight line method typically is what I see typically used because it's simple, it's predictable, but there is a method that is more accurate. In 9.2, they say, what if we use the effective interest method? The effective interest method is a bit more correct theoretically because it recognizes that the true cost of interest is based on whatever the beginning carrying value is. And we know that the carrying value, in the case of a premium, the carrying value started off at like roughly 108 and then went down to 100. So that implies that really the interest should be higher towards the beginning of this loan payoff than towards the end. In the case of a discount, we started off for like roughly about 93 and then the carrying value went up to 100,000. So if we're basing the true cost of borrowing on the carrying value, then the interest expense should change as the carrying value changes. And that's what the effective interest method is trying to do, is be more accurate. We'll see a chart here in a little bit, and you'll see there's not much of a difference. Okay, so how do we deal with that? Well, first and foremost, we don't really need to worry about amortization when we sell the bonds at par. So this is just taking a look at the example 4B and 4C in just a slightly different way. When you're looking at a situation of a premium, you have to be able to do this for the exam. You got to be able to sketch out a couple rows. This looks very similar to the double declining balance method that we saw earlier. You have to have a row. You have to go row by row to determine what the true interest expense is and what the true amortization is. So this is the effective interest method. This is the more accurate method. Start off by, for the first payment, you start off by saying, what's the carrying value at the beginning of the period? That's how much cash we got. You want to multiply it by the market rate. In this case, the market wanted 8%, so you divide that by 2. Every 6 months, the market rate is 4%. You take that market rate, you multiply it by the beginning carrying value. That determines the interest expense to record. So the interest expense in this situation is actually calculated. It's not really the plug figure left over. So if you figure that out, and you know that the cash payment's always going to be based off of the stated rate, 5%, you can start plugging in your journal entry and leave a gap in the middle. So you got the expense of 4,324, you got the cash payment of 5,000. Leave a gap in the middle when you're sketching this out and say, do I need another debit or credit? Here, you need another debit to balance this off. This must be, therefore, the difference being the amortization of the premium. So it's not a fixed amount, though. You can see that it's $676 for the first one, and the second payment is $703. So it's changing over time, but you can see there's a direction that it's moving. And I'm always asking questions on the exam about, how does interest, when we're using the effective interest method, what does the interest expense do over time? Does it increase or decrease? You can see that here that the amount of interest expense we're reporting each period is going down. And the reason why the interest expense is going down is because the carrying value is going down. We're amortizing away that premium, so the overall carrying value goes down. So carrying value, 108, then it goes down to was it 107, then 106, et cetera, et cetera. It's going down, right? So the interest expense, right? This is decreasing over time. That means, therefore, that the interest expense is decreasing over time. The amount that we amortize, amortization, is actually going up over time. This is the case of the premium. So it's just, you need to be able to take a step back. There's always some sort of conceptual question saying, what's the interest expense doing when there's a premium, and we're using the effective interest method. If we're using straight line, we don't have to worry. It's always going to be the same. But in the case of the effective interest method, the amount of interest expense changes over time. Just need to be aware of that. So we plug those things in. Again, the plug figure, when you're doing the journal entry, leave it for the amortization, the amount of amortization. But be able to sketch out for the exam 1 or 2, maybe 3 rows of an amortization schedule. We'll talk about, for the sake of the homework, I've given you a bond amortization payment worksheet that you can use. What about the situation where there is a discount? It's very similar. You just got to make sure that first you calculate the correct beginning carrying value. It's going to be below face, so that's how you know you've done it right. Take your time when you do this, though. Check to make sure you're using the right factors. I'm going to give you present value factors for lump sums and for annuities. You just got to know which factors to use. Do your calculations, add up those present values, you get your market price. That's your current carrying value at time 0. Started off 92640. In this case, was a bit of a typo. The discount was derived because the market wanted 12. Oh, there it is right there. The market wanted 12%. So every 6 months, we're paying them effectively 6% interest expense. 6% is what we're using. It's higher rate, but it's a smaller amount. Ultimately, it results in an interest expense that is higher than the actual cash payout. but do the same thing you did before. Plug in the interest expense, plug in the cash amount that we pay out that's based on stated, and then figure out, what do I need, a debit or a credit? The journal entries, mind you, I'll tell you that, I don't remember every single debit and credit that must take place per transaction, but I do know I can fill out parts of a journal entry based on the information I'm given. So my tip to you is this: don't you don't necessarily need to memorize everything about a journal entry. You need to at least know a debit or a credit, how to get started in a journal entry. Here, I always know the cash payment's going to be fixed. The interest expense is based on the calculation. There's going to be some sort of debit or credit needed to make the journal entry balance. So the journal entry is going to help prevent you from making mistakes. So we see in this case that, what's the dynamic here? The carrying value is increasing over time. It's going 92, 93, 93.7. The interest expense is doing what? Therefore, it's going from 5558 to 5592. So that's increasing over time. The amount of amortization in this case is increasing over time as well. So amort, you see, is increasing over time. And that's just based on the dynamics, okay? If you can just do things mechanically, when you're answering these questions, sketch out an example, then you'll be fine on the exam. I'm not going to try to trick you on the exam, but I do have some tips and some practice for you on how to prepare for this exam. We'll get to this, again, the bond amortization schedule, in a second here. Ultimately, what it comes down to is comparing straight line versus effective rate. Is there much of a difference? Okay, if you just take a step back really, really far from your screen, you can see that they look pretty similar. The straight line method, the carrying value started off at roughly 108, and down below it was 93. So this is the discount, right? And this is the premium up above. We started up really high, right? But in the straight line method, we were bringing it down in fixed chunks, about 8, 11 per payment period. Ultimately, I'll go down to 100,000. In the case of the discount, we brought it up, and it was 736, right? Fixed amount. Is that simpler method so incorrect relative to the effective? Not really, not by much. Okay, you can compare the 811 to the streams that we just calculated above. It's not much difference. That's why in practice, a lot of companies tend to use a straight line method, because there's not a material difference between what we're actually amortizing on the straight line method versus what we use in the effective method. Here you can see there is a slight curve on the way down, slight curve on the way up, but ultimately they go in the same direction. And just be able to, for the sake of exam, sketch out, if it says effective interest method, sketch out 1, 2 rows of the schedule, the payment schedule, and then answer the question. For the sake of the homework, it might ask you to do a little bit more. So what I've done is, up on the on Blackboard, you'll see this bond payment and amortization schedule. It's another schedule, Excel document that I put together. So if you're having issues with it, reach out to me and I can help debug it. When you download this thing, you open it up, it'll probably be set to, I think it was set to 12%. It will automatically update everything in the schedule based on what you input in the yellow. So if let's just say that it was 5 years, but it was annual payments, if you hit enter, it will automatically adjust the number of rows that you see. And if you bring it down even further to say 3 years, enter, you can see it automatically adjusts everything. So all you really need to do in this Excel spreadsheet is pop in the face value, the market rate, stated rate, number of life in years, number of payments per year, and you'll be fine. So you saw here that in the previous example, we said a discount. So it was 5 years, and it was 2 payments per year, enter. And there's the amortization schedule that we saw in the PowerPoint slide. 6% is the market rate. 6% is multiplied by the beginning carrying value to determine interest expense versus the actual cash payout. The difference is the amortization. It even says discount in this case. And then you can see the carrying value keeps going up, 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 ultimately to get 100,000 payoff at the time. If I change it to 8%, you can see that it changes this to say premium. So this is a pretty self-contained schedule you can use for the sake of getting your homework done quickly and efficiently. But make sure you understand the dynamics of why things are working out. Here we see we're starting off at 108. It goes down to 100,000. So the carrying value is decreasing over time. Why did we get an extra $8,000 to begin with? Well, it's used to help make the interest payments. We're legally required to pay off $5,000 each period. That's cool. I don't want to do that if the market doesn't want as much as the 10% or 5% per period. If the market only wants 4% every 6 months, I want to pay him 4% for 6 months. So ultimately, what I'm truly paying out of my bank account, my own personal bank account, is roughly about 42,000. The cash that actually is written on the check is mostly coming from my own personal cash coffers. The other part is from that initial $8,000 extra that they gave me when they started this. So they gave me $8,000 extra. I'm using some of their money to pay them these interest payments. They're helping me out. So the true cost of borrowing is what I'm actually pulling from my own personal bank account. If we said though, oops, not 20, said 10, hit enter. Now, see, in this case where you have 10, the market equals the stated rate. What I'm paying them is exactly what they want. So there's no difference. It's all just kind of boring. It's the same journal entry. In the case where we have the 12%, right? How much did I actually pay out of my own personal bank account? I actually paid out total cash for interest of $57,360. The payments, the interest payments, were only $5,000 every time I make an interest payment. But remember, at the end, I gave them not just their $92,000 back, I gave them an extra $7,000 back. The total amount I paid was the $100,000, $92,000 of their original money, another $7,000 more. That $7,000 represents the additional amount to make it equal the market rate, the 12%. The spreadsheet's pretty self-contained. Also, you see on the far right side here, it will recalculate the price. It will show you the present value as broken down between the lump sum and the interest payment. So feel free to play around with that. You don't have to use it. I recommend doing it. If you have any issues with that schedule, let me know.